Hello and welcome to DIY Investing YouTube channel. We are covering international business machines today, ticker IBM. Over the next few minutes, I'll discuss my thoughts about valuation of this company and its business quality. This company is operating in the IT services industry. They have a market cap of $134 billion, enterprise value of $172 billion. So you can see about $38 billion in net debt on this business. That's about 20% of the overall enterprise value. That's a pretty significant amount of debt for a business of this size. So they are operating integrated solution services worldwide. You've probably heard of IBM. I certainly have. They have 4 segments: software, consulting, infrastructure, and financing. They're certainly making a lot of the computer stuff. They have hybrid cloud platforms. A lot of this is just they have on-premise software workloads, infrastructure, cloud-based servers, storage. Basically, they do a lot with computers, and that's kind of how I think about it. And maybe that's a dated way, but they have a financing segment as well, which is kind of interesting. So probably helps you finance your own purchase of the company. I don't really like companies that have that set up in there, but it certainly works depending upon the overall business model. But it's something to be aware of that can distort some of their results. Let's go to return on invested capital. The first thing that looks really good is you see here that they have 22 straight years of profits. Anytime you have 22 straight years of profits, it's instantly under consideration as a high quality business. It's hard to make a profit in business. It's hard to make a profit consistently through the business cycles. You can see here, 2002 recession, they still had a 7% return on invested capital. 2008, 2009, they were actually accelerating with really good returns of invested capital, 22%, 27%. They peaked in 2012 at 31% return on invested capital. The unfortunate thing is although they've made a profit through this entire time, you can see a clear deterioration on the returns on invested capital. They're getting worse and worse returns on there over time, peaking at 31%, 28, 20, 24, 21. 0.6. So in 2016, they were still above 20%, but they've not reached it since then. In 2017, they dropped down to 9, 13, 12. And of course, in 2019 was the last time we saw double-digit returns on invested capital, and now we've had 3 years in a row below, so 6%, 7%, and 2%. I really dislike deteriorating returns on invested capital because although they're still profitable, you are now below 10%, which is what I want to see, and you're getting worse and worse over time. If this were to continue, it's easy to see how they could in future years be losing money. And so we need to diagnose why that is, because you look at this and say, hey, this should be a high profitability company, high quality company, but this deterioration is a major concern because what matters is the future. When we look at these 10-year median returns, this is the past. Average 10-year return on invested capital, 13.1%. So the last year that we had that 13% return was 2018. And so you had half the time you were doing better than that and half the time you've done worse. But all the time that you've done worse has been in the last 5 years, last 6 years. So it tells me that maybe the future is much worse than we had in the past. Return on equity of 50% looks great, but what's been the return on equity of the last few years? 8% in the last year, 29% in 2021. So these returns are actually quite poor. Now, the other thing we want to do though is how have their earnings and revenue gone? And it looks like we have negative CAGRs on all of them. So revenue has been declining at 5% per year. Free cash flow, 5% per year. EPS, 18% a year. These are massive declines. It is very hard to properly value and assess a company that's declining because with a lot of companies, there's some level of operating leverage. Operating leverage means that, if you grow your revenue at 5%, maybe you can grow your earnings at 6%, 7%. And that little boost is because you're growing and your costs are not growing as fast as your revenues. Well, if your revenue is declining, the same thing can happen in reverse. A 5% revenue decline here you can see is equating to an 18% decline in earnings. And that is just a double whammy that really hits hard. So you need to be aware of that as a concern for you as a shareholder in the future. And so for here, that's a major problem for me. I mean, we can talk about PE here of 19, but first we really need to understand what this is doing. You started out the decade with $98 billion in revenue. You decline 92, 81, 79, 79, 79, 57, 55, 55, 60. We have lost over a third of our revenue, almost 40% of our revenue in the course of a decade. That's a very, very bad result for shareholders because it means you've lost all that ability to continue earning that money. Your gross profit has also catered. You've lost less gross profit. It looks like about 25% from 48 billion to 32 billion. But you can see your operating profit has declined over 50%, 20 billion to 8 billion. So earnings per share has gone from basically $15 a share to $1.80. So almost an 80 to 90% decline in your earnings from this. And despite your earnings hitting $1.80 in 2022, they paid out more than $6 in dividends. So you see $6.50 dividends. Their dividend has exceeded their earnings now 3 years in a row. This is a major red flag for me when I think about this, because at some point this dividend would have to be cut if they can't support it on their earnings and free cash flow. Now, obviously you support dividends from free cash flow, not earnings, but this is not the setup you want to see as a shareholder. So let's compare that to our stock price. So we have a close here of $147. But they had $1.80 in earnings. So the real PE on a 2022 basis is, somewhere between 50 and 100 times earnings. Now, that's probably not the right number to use. If I go to our income statement, I'm probably going to see a little bit better numbers. And you do see better numbers on the trailing 12 months. So we're going to look at that. But again, even if you're using the $6 number here, you're easily in the range of PE in the 20 range. Why would you pay a PE of 20 for a company that's declining? This is a worsening business based upon what we're seeing here. So I have major concerns about the valuation. You can make money buying companies with declining revenue. But if this declining revenue of 5% is what we should really plan on over the next decade, you need to be paying a PE of probably not only less than 10, but something like a PE of 5. And so that's 75% lower than what we're seeing here, even if we take this PE number as accurate. So just something to be aware of. And of course, the big debt overhang is going to be a problem. If you're learning something from this video, hit the like button. Don't forget to subscribe. But we're going to go to the income statement next to kind of learn a little bit more. Now, something that's interesting, that's probably a part of the reason of why you're getting some worsening operating leverage is you see this research and development line. And so, when you have declining gross profits, that means you have less money to cover your operating expenses like SG&A, research and development, that sort of thing. And so you want to see something like this where your SG&A is decreasing at the same time your gross profit's decreasing. That's how you maintain your business and you don't go bankrupt. But the R&D has been going up. So our research and development is up somewhere between 15 and 20% over the course of the last decade, even though our gross profit has declined by 25%. And that's causing part of this operating profit mismatch where you go from 20 billion down to 8 billion. Now you do see some improvement in this last year, so that is something to be aware of. And we can see a big non-operating write-off of almost $6 billion in 2022, which is affecting that $1.80 number. So that's not a good number to say, what is it going forward? And probably something like this $6 to $7 is a more accurate number. So we can say, hey, yeah, let's take that for face value as what it is, that it is a PE of 20. But a PE of 20 is still very expensive for a company that's declining. And so that's a major concern. Now, I do believe one of the things with IBM, and we're going to have to take a look at their dividends, is that they've been buying back shares. And you can see, at least over this period from 2013 to 2019, they retired about 20% of their shares because they went from 1.1 billion shares down to 900 million shares. That's about 20% of their shares that they were able to eliminate from the market over that 6-year period. That's a pretty good buyback. Now, it stopped and their shares are now going back up. So we're going to have to see if, once they ran out of cash, they're no longer able to do that. But let's look at balance sheet next. You can see total current assets has gone down. They pulled about 20 billion off the balance sheet there. So this is one concern. If you look at your total assets, at the beginning of the decade, they had 119 billion. At the end of the decade, they had 127 billion. So you have more assets today than you had back then, and yet your income is less than half of what it was. So that is just a key reason why your returns on invested capital have collapsed, is because you have more assets and less income. And that mismatch is a setup for disaster as a shareholder because you're getting worse and worse returns on your balance sheet. Now, the composition has changed a little bit. You can see that a lot of the increases come from goodwill. You have big acquisition here clearly in 2018, 2019, going from 36 billion to 58 billion. So you added 22 billion in goodwill there. You added 12 billion in intangibles. So that is on the balance sheet. So you have, half the balance sheet, 55 plus 11, $66 billion here are intangibles. But that's still a relevant part of the balance sheet. That is past acquisitions that they've made, which has proven to not be helpful to them. And so you need to be aware of that this is basically past mistakes that is now embedded in the balance sheet, and you're getting bad returns on that capital. Now, on the tangible basis, the returns are still probably okay. I'm not going to say good because you see PP&E here of 8.2 billion, but you still have these current assets that you need to count. You can't just eliminate all of that, but you have a lot of expenses there. Short-term debt, $5 billion. Long-term debt, $46 billion. So you have $50 billion in debt. That's significant. So $50 billion in debt. When we compare to the income statement, and you say you have maybe $6 billion in profit. So you have $6 billion in profit, $50 billion in debt. It's like 9 times your income. 8 or 9 times your income in debt. That's a massively distorted and leveraged balance sheet and would be an immediate red flag for me as a shareholder. And that's not even counting your pension liabilities. You have an additional $11 billion in pension liabilities. This is a really bad sign on a balance sheet. I don't like seeing pension liabilities because it's very easy to underestimate those. They could be much higher than reported. So they are reporting $11 billion. Those liabilities have been coming down, so it's possible that they froze them at some point in the past. But there's all sorts of assumptions that go into this number, so you really need to dive into the 10K to understand what are they assuming. Are those realistic assumptions? Because the pension could cost them a lot more than they're holding on their balance sheet for. And so I really don't like investing in any companies that have pension liabilities more than a de minimis amount. And this is $11 billion is not de minimis. I mean, that's, at least 10% of their overall liabilities. That's a lot of liability. Go to the cash flow statement. I really want to see this common stock. So you can see these big buybacks, right? And buybacks continued in a large degree through 2018, and then they started falling off 2019, and they still are doing them. But what you can see is that for this period from 2013 to 2019, they were larger than your stock-based compensation. But the stock-based compensation has now gone up, and they're basically having stock-based comp of about $1 billion a year. And they're not nearly paying enough in buybacks to offset that. And so now we have share count rising again, which is a major concern. I don't know why you have all these tech companies think you can just give away stock and it's free. It's not free. It costs shareholders money. You need to be aware of that. That is a major concern. Now they have a decent amount of cash flow from operations. Even here in their worst year was $10 billion. So of course that cash flow is what they can use to pay debt, interest, and everything like that. But even in this year, you see they're taking on more debt. And they are paying out a lot in dividends, $6 billion annually in dividends, and their income statement right around $6 billion. So, of course, they're getting the benefit of some of this cash flow stuff. Depreciation, amortization is a big part of it. So your cash is going to be higher. But it's something to be aware of. They're making big acquisitions, $31 billion, $3 billion, $1 billion, $6 billion. And they're doing that and still having revenue decline. So those are real costs. This is like doing CapEx. This is like doing PP&E. There's a reason we don't ignore goodwill on the balance sheet because it's very similar to that. You're paying real money to make those acquisitions. It should impact your balance sheet. It should impact your returns on invested capital. We're seeing that here. I basically don't see anything I like in IBM, so it's an immediate pass for me. I hope you've learned something from this video, found something useful that you can take away for process. I have covered all the videos I like in the playlist that I have here in the show for my watch list stocks. I hope you'll check those out. Those are stock I like. This is one that I just happen not to. But if you learned something, hit that like button. Don't forget to subscribe. And if you want to use this software that I am, quickfs.net, my affiliate link is the first link in the description below. You can use this software for free or a paid account, but please consider using my link to check them out. Thank you for listening, and until next time, stop paying fees, start building wealth.